Welcome to the research desk. Every investor knows the slogan, "You never make money beyond your cognition." It sounds clean. It also hides a trap. Sometimes you do make money beyond your cognition. A stock goes up for a reason you did not see. A policy cycle turns. A new technology story appears. A hated market becomes fashionable again. The money is real. But the lesson may be false. That is the dangerous part. One lucky win can teach the wrong skill. It can make a trader think he had insight when he had exposure. It can make a value investor think a thesis worked when the regime changed under his feet. So today, we need a simple equation. Return equals thesis quality times position sizing times holding power times regime luck. Say it again, slowly. Return equals thesis quality times position sizing times holding power times regime luck. The formula does not predict the future. It does something more useful. It keeps your postmortem honest. Investing has a measurement problem. The scorecard is price. The causes are hidden. A stock can rise because the investor understood the business. It can rise because the position was sized well. It can rise because the investor held through pain. It can also rise because the world changed in a way nobody controlled. The account statement only shows the result. It does not show the cause. That is why postmortems become dangerous. Winners get explained as genius. Losers get explained as bad luck. The mind protects itself. Mohnish Pabrai's Micron investment is a clean example. He started buying Micron in the fourth quarter of 2018. Public transaction trackers show the first reported position around that period. His logic was easy to understand. DRAM had moved from brutal competition to an oligopoly led by Samsung, SK Hynix, and Micron. If the industry had changed, the old low multiple might be wrong. That was the thesis. Then 2022 and 2023 arrived. PC and smartphone demand collapsed. Memory prices fell. Micron's revenue fell hard. The business posted severe losses. Pabrai exited by 2023. Later, Micron caught a new wave, AI servers and high bandwidth memory. The stock could rise after the exit. But that later rise did not prove the original thesis. It came from a different causal chain. That is a problem this equation solves. It asks one question. What did you actually earn? The first ingredient is thesis quality. Thesis quality means the causal chain. Why should this asset reprice? What is the mechanism? What would prove you wrong? A good thesis is not a story. A good thesis is a testable chain. If A happens, then B improves, then C re-rates. If X happens instead, I am wrong. The second ingredient is position sizing. Sizing turns insight into result. A correct idea with a tiny position is a footnote. A large position with a fragile thesis is a grenade. Sizing is where courage meets risk control. The third ingredient is holding power. Holding power is not stubbornness. It is the ability to sit through volatility while the thesis is still alive. The phrase "still alive" matters. A falling price is not always a broken thesis. A broken thesis is not always obvious in real time. The fourth ingredient is regime luck. Regime luck is the part you do not control. Rates fall. Liquidity returns. A regulator changes tone. A war ends. A new technology narrative appears. A country risk premium compresses. The market suddenly wants what it hated last year. In investing, luck often arrives as regime change. Now return to the equation. Return equals thesis quality times position sizing times holding power times regime luck. This is a multiplication model. That matters. If thesis quality is near zero, a large position becomes dangerous. If position sizing is near zero, even a brilliant thesis barely affects wealth. If holding power is near zero, the investor may sell before the payoff arrives. If regime luck is hostile, the right idea can sleep for years. Addition would be too kind. Multiplication is harsher. It matches investing better. A simple scoring version uses 0 to 5 for each factor. 0 means absent or destructive. 1 or 2 means weak. 3 means adequate. 4 means strong. 5 means exceptional. The point is not false precision. The point is discipline. You force yourself to ask which factor did the work. If a stock doubled because the entire sector re-rated, you should not call that pure security selection. If the thesis was right, but the position was too small, you should not call the result a success. If you sold before the thesis played out, you did not have holding power. The equation turns vague pride into a checklist. There is one more reason the equation uses multiplication. The weakest factor sets the ceiling. Think about 4 investors. The first investor has a strong thesis but no size. He writes a brilliant memo. He buys a 1% position. The stock triples. His portfolio barely notices. That was insight without exposure. The second investor has size but no thesis. He buys a large position because the chart is moving. If the regime keeps helping, he looks brave. If the regime turns, he discovers that size without cause is not conviction. It is leverage to ignorance. The third investor has thesis and size but no holding power. He buys well. He sells during the first drawdown. Then the thesis works without him. That is not bad luck alone. That is a mismatch between time horizon and temperament. The fourth investor has all three craft factors. The thesis is clear. The size is right. The holding rule is defined. Then the regime refuses to help. Rates rise. Liquidity drains. The market will not pay for the idea. That investor may look wrong for years. But the postmortem is different. The process may still be valid. The weather was hostile. This is why a single outcome cannot grade an investor. You need the factor map. It tells you whether to fix the thesis, fix the size, fix the temperament, or simply admit the regime did not arrive. Now use that map on real names. Take Alibaba. A common Alibaba thesis says this. Alibaba is a dominant China internet infrastructure company. Its core commerce business still throws off cash. Its cloud and international businesses add optionality. Buybacks shrink the share count. If regulatory pressure fades and China sentiment improves, the market may stop pricing the company as permanently impaired. The causal chain is simple. Regulatory pressure peaks. Cash flow stabilizes. Buybacks continue. China risk premium compresses. The multiple re-rates. Thesis quality is decent. The cash flow and buybacks are real. Alibaba said it repurchased about 150 million ADS equivalents during the fiscal year ended March 31, 2025. It also reported a net share count reduction of about 5.1%. That is a hard capital return anchor. But the thesis is not purely company controlled. It needs China consumer confidence. It needs regulatory calm. It needs foreign investors to care again. So thesis quality might be 3.5 out of 5. Position sizing should not be heroic. Alibaba is not only a business bet. It is also a political and macro bet. That argues for a meaningful but survivable size. Sizing might be 3 out of 5. Holding power has to be high. This kind of trade can spend years looking stupid. If the thesis is deep value plus normalization, the investor must define what breaks it before the pain begins. Holding power might be 4 out of 5. Regime luck is large. The upside depends on China risk premium, policy tone, currency, and global appetite for Chinese equities. Regime luck might be 4 out of 5. The verdict is not Alibaba is good or Alibaba is bad. The verdict is sharper. Alibaba is a company value thesis multiplied by China regime luck. Now take Intel. The Intel thesis says this. Intel is a fallen strategic semiconductor asset. It has manufacturing know-how, government support, and foundry optionality. If the process roadmap works, and outside customers trust Intel Foundry, the market may stop pricing the company as structurally broken. The causal chain is this. Process roadmap improves. Foundry credibility rises. Customer wins appear. The capital burden is partly offset. The multiple re-rates. Thesis quality is weaker than Alibaba's. The assets are real. The policy support is real. Intel has talked about Intel 18A, advanced packaging, and a foundry strategy for the AI era. The U.S. CHIPS Act also made domestic semiconductor capacity a strategic goal. But the thesis requires hard technical execution. Intel must win trust from customers who already rely on TSMC. That is not just sentiment. That is proof. Thesis quality might be 2.5 out of 5. Sizing should treat Intel like a turnaround option, not a compounder. Too large a position assumes the execution before the evidence arrives. Sizing might be 2.5 out of 5. Holding power must be conditional. You can wait through volatility. You cannot wait through repeated process misses, cash burn, and no customer traction. Holding power might be 3 out of 5. Regime luck is high. If the world shifts toward domestic strategic fabs, Intel benefits. If the world stays with TSMC and NVIDIA as the center of gravity, the thesis struggles. Regime luck might be 4 out of 5. So Intel is not a normal value stock. It is a turnaround thesis multiplied by industrial policy regime luck. Now comes the wall. The wall is attribution error. You can be right for the wrong reason. You can be wrong for the right reason. You can make money and learn nothing. You can lose money and still have a process worth keeping. The formula does not let you hide. If the money came from thesis quality, you can study the pattern and repeat it. If the money came from sizing, you can improve portfolio construction. If the money came from holding power, you can study temperament and liquidity structure. If the money came from regime luck, you can be grateful. But you should not pretend it was skill. This is where Micron teaches the hard lesson. The original Micron thesis was about a memory oligopoly and lower cyclicality. The later AI and high bandwidth memory story was a new regime. A stock can be the same ticker and still become a different investment. Same symbol. Different causal chain. That is the wall. There are 3 practical mistakes to avoid. The first is the cheapness trap. A low multiple is not a thesis. It is a starting clue. You still need to know why the multiple is low. You still need to know what changes it. You still need to know what proves the discount deserved. The second is the survivor trap. You only study the investors who made it through the regime. You do not see the ones who had the same thesis, the same confidence, and the same language, but were forced out before the payoff. That is why holding power includes liquidity. It includes fund structure. It includes personal cash needs. It includes whether you can survive being early. The third is the narrative transfer trap. This is the most subtle one. You buy one thesis. The stock later rises on another thesis. Then you quietly rewrite your memory. You say you saw it all along. Maybe you did. But if you did not write it down before the move, be careful. The market just handed you a new story. That story may be useful. It may even be true. But it was not the reason you bought. This distinction matters because investing is a learning machine. Bad attribution corrupts the machine. It makes you repeat luck and abandon skill. Good attribution does the opposite. It lets you keep the craft and thank the weather. So how do you use the formula? Use it after every major investment decision. Before you buy, write the 4 factors down. First, state the thesis in 1 sentence. If you cannot, you do not have one. Second, write the causal chain. Use arrows. Force the logic to move from cause to effect. Third, define the break rule. What fact would prove the thesis wrong? Fourth, size the position according to the weakest factor, not the strongest one. That last line is the trade. Most investors size by excitement. They should size by bottleneck. If thesis quality is strong but regime luck is needed, do not size it like a sure thing. If regime luck is favorable but thesis quality is weak, do not confuse a hot tape with insights. If holding power is low, reduce the position until you can think clearly. The formula is not a magic machine. It is a mirror. It tells you where the return really came from, and it tells you what you can carry into the next decision. 1. Investment return is thesis quality times position, sizing times holding power times regime luck. 2. The first 3 are your craft. The 4th is the market's weather. 3. Keep the money if it comes, but only repeat the part you can actually explain. This is the research desk officially signing off.